And welcome to this episode of the Hawaii Retirement Show. We're continuing on part 2, breaking down the 20 most common investing mistakes by the Chartered Financial Analysts of the CFA Institutes. Jason, we're going to jump on to 11 through 20 here. How are you doing today?
Yep, doing good. Happy to pick this thing up right where we left off.
Perfect. So with that, let's just do it. Jumping right into number 11. So number 11 is not knowing your performance. Often investors don't actually know the performance of their investments. Review your returns to track if you are meeting your investment goals, factoring in fees and inflation. That's a big one.
Yeah, I like at the end, the fees and inflation, because you can look at I would add in there too is dividends with if you're reinvesting those dividends, that can impact the overall performance of your portfolio a lot.
Absolutely.
And yeah, tuning in to see what are my returns. And if somebody, if you look at a chart or you log on to your custodian or your advisor shows you a percentage, okay, what does that represent? Is that 1 year? Is that 3 years, 5 years? And also looking at those things. So a lot of people maybe this year are like, hey, things are pretty good. Okay, so let's look at 2 years. Oh, okay, maybe it's not as good. Okay, what does 5 years look like? Oh, things are pretty good. So it's I think having the time frame and checking in on your performance is a big thing.
Yeah. And I mean, I think understanding that, you're not, we shouldn't be expecting like a specific percentage year after year. It's always a range, right? It's never going to be like always this double digit return. It's going to be, several different numbers. But, for me, I would say maybe I'll take a contrarian view, like, know your performance and know those things, but don't like, that's not the sole deciding factor on things too. Right.
Sure.
Yes, performance is important. But there's not a lot of control in the up and down of the day-to-day market, right? So no, like I think what you said is really great. Knowing which perspective, is it a year perspective? Is it 5 years? Like how are we actually evaluating this performance number?
Sure.
So yeah, it's great.
No, I like it. Okay, number 12, reacting to the media. Dun dun dun. Negative news in the short term can trigger fear, but remember to focus on the long term. All right,
Yeah.
the media, Paul.
Yeah, the media, man, I'll be honest, like I only have a few things that I watch and listen to, but I don't listen to major news media for financial investment advice, right? Like if that's what we're doing, then we're allowing the clicks, the baity headlines, we're allowing those things to dictate our feelings and emotions and honestly our futures. And if that's where you're at, take a hard line here, like I would encourage you to stop doing that,
Sure.
because really like the media it's a business itself, right? It's trying to create revenue by eyeballs on TV or subscribers to this news feed.
Right.
So again, I would come back to, as we alluded to in the part 1, like a lot of this is, who's helping you, do you have an advisor? And maybe consider evaluating what you're hearing before you're making decisions, and saying like, hey, like, Jason, what do you think about this? Like, I heard this. Oh, that's, whatever
Right.
the cause or whatever the concern is. Right. And, for me, like, I do work with a lot of people that listen to news. I'm sure you do too, but, so it's a lot of just like bringing it back, like focusing back to the goal, what we're trying to do, what's at hand, and not letting fear drive you. That's how I'd say.
I like it. And there's a lot of good media out there. It's just you really gotta, I mean, nowadays more than ever, you really gotta think for yourself, and you almost have to approach everything with a little bit of healthy dose of cynicism.
Yeah.
Um, it's interesting times we're living in with the media. So
Right. Yep. It's totally true. All right. 13. Ready? Here we go.
right.
I think so. This one is forgetting about inflation. Historically, inflation has averaged 4% annually, according to the CFA Institute.
Hmm. Yeah. So inflation definitely has to be calculated in. Where I see inflation not included the most is when I'm working with somebody for some real long-term retirement planning, and they're using today's numbers
Yeah.
and not factoring in inflation into what those projections are. Um, but yeah, you have to net inflation out against your investment returns, right? Because your purchasing power is decline. If you earned a 7% return and there was a 4% inflation for the year, your purchasing power went up by 3%, right? Pretty
Yeah.
simple math there.
Yeah.
Um, but it's yeah, it's something I think that's overlooked, except in times like now when inflation really hits you,
Yeah.
like the current state we're in, where people start to really notice it. But when things are good, I think it's easy to overlook inflation.
Yeah, and again, I'm just going to use this example that they have here on this chart just because I think it's a really good thought process. So it says your value of $100 in a year from now is going to be $96.
Mm,
Your value of $100 in 20 years from now is going to be valued at $44, right? So again,
right.
like Jason said, it's all about purchasing power. And part of the reason why we need investment returns is because of inflation, right? Yes, we do want our money to grow because we want to have, a nice nest egg or what have you. But it also, it's because, the gallon of milk today in 20 years or 30 years from now is going to be, with inflation, it's just going to cost more, right?
Sure.
Um, yeah, it's great.
Yeah, we got to outpace inflation to maintain some purchasing power. So
Yeah.
move on. Number 14, trying to time the market. We kind of touched on this in one of the other ones a little bit with which one was that? Maybe buying high and selling
Yeah,
low.
probably.
I kind of touched on. I think that was number 5. But trying to time the market. Market timing is extremely hard. Staying in the market can generate much higher returns versus trying to time the market perfectly.
Honestly, this breaks it down perfectly. Like it's
Mhm.
really hard. No one has a crystal ball. We don't know what's going to happen in the market. Yes, there are signs, there are indicators, but reality is, um, what's going to happen tomorrow. If someone tells you for certain they know, then I would have a red flag, right? um, but what I would say here, and I think we alluded to it earlier, but I think we should focus a little bit more on, if you're invested in a well diversified portfolio, you're getting dividends for holding a lot of these things. You're getting, there are other benefits than just percentage growth of those investments, right? So the more that we're in the market, right? So like I said in that one, it's not about timing the market, it's about having time in the market, right?
Yep.
So if we are actually allowing those investments to work and creating dividends and creating capital gains and creating different things that, it continues to grow over time, it's about having a quantity of those things. We're trying to just accumulate, assuming that you're in the accumulation phase, right? um but again, having a goal, having it planned out is really important.
Yep. I don't think anybody saw the global pandemic coming.
No.
And and that stuff like that is kind of what this point is taking into consideration, right?
And yeah, exactly. And no one would have said that they saw that big spike right back up like really
Right.
really quickly, right? And again, like, it's so hard to know exactly
Mhm.
what's going to happen. Yeah.
Yeah.
All right, anyway, we'll keep moving along here. 15, uh, not doing due diligence. So check the credentials of your advisor through sites like Broker Check. The SEC also has one if you're with the SEC like
Mhm.
myself, um, which shows their employment history and complaints. Man, I love this one.
Yeah. Yeah. So there's, and obviously me and Paul will be biased here because we are advisors, but I mean there's strong data that suggests that working with an advisor is beneficial for multiple reasons to an individual. Advisors come in all shapes and sizes. They got all different backgrounds and credentials and employment history. So yeah, I think it's good to know who you're working with. It's kind of funny how people find their advisors. It's my college roommate's best friend. Well, does that really qualify him? I'm not saying it doesn't qualify him, but don't be afraid to dig a little deeper and ask the questions. If you have an issue that you're trying to solve for in your retirement planning and your investments, be very direct with the advisors and say, this is what I'm looking for. Can you help me? And why are you qualified to help me? And being real direct, and know that they're the right person to guide you through it.
Absolutely. I mean, for me, when you're looking for an advisor, you're looking for someone that's going to be willing and able to talk to you, especially with hard conversations. I mean, money is not an easy topic to talk about. Um, so, having someone that not only just understands you, your circumstances, but also where you're wanting to go, they're a lot of different skill sets, lots of different types of, yeah, like Jason said, lots of different people out there to help you. But yeah, there are great resources out there. People have, we are regulated, so that type of information is out there. And don't be afraid to interview a couple of different people, right? I personally like to say that I would like to interview my clients too, because it's a two-way street.
Sure.
If this isn't going to work, it's not going to work, right? And I'm not here to say I can solve every need. So yeah, anyway.
I like to think of it as your primary physician, your doctor, right? You want to find somebody that you feel good about, right? Not and they all went to medical school, they all, you know, have their MD, but there's the right guy where you feel comfortable, you trust him, you trust his knowledge, and that's what it's really about.
Yeah,
Um,
absolutely.
so it looks like 15 was not doing your due diligence as
Yeah.
far as advisors, and 16 is working with the wrong advisor. So we kind of already covered 16 before really going into it. So we'll jump past 16 because we just touched on that, and we'll go to 17. Investing with emotions. Although it can be challenging, remember to stay rational during market fluctuations. All right, Paul.
Wow. Well, this one is it's a good thought process for life, right? I feel like,
Mm,
um uh don't I mean allow your emotions to be a signal, but don't let it
mm,
be, or I've heard it say, allow emotions to be the gas pedal, but don't allow it to be the steering wheel, right?
right.
um yeah, so if you allow your emotions to dictate um the actions you're choosing, you're allowing other variables out there impact you, and those can be very irrational, right? So
Right.
investing specifically, again, having that, having it designed, plan, there's a plan of attack, it's a strategy here. So with the ebbs and flows of those emotions, we can always recenter on, hey, here's where we're trying to go. And only if those really change will we need to make those changes.
Yeah, I love there's this talk by Malcolm Gladwell called Pull the Goalie, and it's about the analytics of when is the optimal time to pull your goalie in hockey to give yourself an extra man advantage to try to score a goal, right? And if you break down the analytics, there is no team or coach in hockey that's pulling their goalie early enough.
Yeah.
What's the reason? The reason is the fear of getting blown out or letting up more goals overtakes the analytical and the right decision to pull the goalie and try to even the game or win, right? The goal is not to not lose by 3, right? The goal of the hockey game is to win or draw. You get points if you draw, right? And so
Right.
if you're very analytical and not emotional about it, and you're okay knowing, hey, if we lose 0-4, I still have to, that's okay because the goal is to win. It's the same if I lost 0-1 from an analytical perspective. Now, from
Right.
an emotional perspective, as a fan, you're saying, oh, we stink and I can't believe we just got blown out. But if you play the pure analytics, you pull the goalie early and you give yourself a chance to win. And that's a little tangent, but I really like that talk by him. And it really goes into how our emotions can get in the way of making good analytical decisions.
Yeah, absolutely. And in a lot of senses, emotions are there for a reason. Like I said, it's a check engine
Sure.
light. It's a little raised flag. Whether it's anger or sadness, whatever that emotion is, it's just there to be an indicator, right? And so,
Right.
how do we move forward with that indicator, right?
Right.
You definitely don't want to leave it unchecked, right? Just like your engine. If the engine's telling you to
Sure.
check it. um, anyway, moving on to 18. So 18 is chasing yield. High yield investments often carry the highest risk. Carefully assess your risk profile before investing in these types of assets.
Yeah. So if you want the high returns, you got to expect high volatility a lot of times. And yeah, that's the thing where you can look at a fund or a individual stock and you see this shiny high percentage performance and you think that's what I need, that's where I'm going. But is that a realistic um goal to be chasing, or is that a flash in the pan, or and is if that goal is realistic to chase, am I willing to accept everything that comes along with chasing that goal, right? Because again, you don't get your cake and eat it too, right? There's
Right.
that saying. So are you going to accept everything that goes into chasing those yields?
Yeah, and I think it's important to know, the disclaimer, past results is not indicative of future results, right?
Sure.
So if a fund or a stock has performed really, really well over the short term, maybe the last 3 months, 6 months, or a year, it doesn't mean that it's going to continue to do well, right? And you know, yeah, so chasing is always not necessarily a great position to be in, which is why planning and setting things up early and staying on track is
Sure.
more important than trying to chase, right?
Yeah, and I would say one thing that's not on here that kind of falls into chasing the yields is everybody wants to be outsmarting everybody else, right? You want to be making that one move that nobody saw it. Me and a few people saw this coming, and we're gonna clean house with this, right? Everybody loves that type of situation, but law of averages and being realistic, is that something that's really going on, or is that something you're just hoping that
Right.
happens?
Yeah, I mean, I think that's related to comparison, which is it's funny because what are we comparing to? What, right? Like, I'm not sure if someone said like, oh, like, how's your portfolio doing? I did really, really well. Like, I don't know if
Hmm.
people have those conversations, but that really shouldn't mean anything because
Right.
they did good or whatever. But it doesn't necessarily impact me and where I'm going. And it's really funny too. One thing I'll share is like, when things are going really, really well, people like to talk about it. And then when things
Sure.
aren't, they're like, oh, it's okay. Where it's like, hey, you know what? It's okay. It's not to be shameful or embarrassed. It's like, hey, there are some, like you said, law of averages, right? If we do
Hmm.
what we should be doing, it should work out.
Right. Okay. Two more to go, and we'll wrap this up here. Number 19, neglecting to start. Consider two people investing $200 monthly, assuming a 7% annual rate of return until age 65. And what they show is so the end of the portfolio, if they started at age 25, is 520,000, and it's 245,000 is the end of the portfolio if they started at age 35. So just starting early, getting that compounding is what this is all about.
Yeah, really, that's what it's explaining. And that 10-year window, right? 25 to 35, doing nothing. That's the real rub, right? It wasn't
Mm-hmm.
that like the performance was the same, it wasn't like they were saving more money. Like it was all about the time, right? And time is either on our side or it's not. And if you are someone that's maybe time's not on your side, that doesn't mean you shouldn't start, right? Like the saying, right? When's the best time to plant a tree? Well, 20 years
Mm-hmm.
ago or
Right.
today, right? Again, it's you got to get started. Um, but yeah, this really just drives home the importance of not timing. It's just
Mm-hmm.
getting started and just trudging away. two hundred
Yeah.
dollars $200 a month in this example, right? And maybe for you it's
Mm-hmm.
more, maybe for you it's less. It just depends. But really, you know, understanding like even starting small when you're 18 or 20 or
Mm-hmm.
25, right? Time is really important.
Right.
Timing is not.
Right. Yeah, it's one of those things. There's never a good time for a lot of things, right? So you just gotta do it. Put action into it, right?
Yeah.
And I like what you said. A lot of times people, well, I want to start saving, but I have X, Y, and Z, and I need this money for this. And you just got to take action. Like you said, start small and establish those habits. And take advantage of the time and the compounding there.
Your future self will thank you. I'm not sure if you've
Sure.
heard that before, but your future self will thank you, right? I
Sure.
mean, that's just how this system works.
Mm-hmm.
All right, 20. Is it my turn to ask this
It
to you?
is. Yep.
Yeah, okay.
You close us out here.
All right, here we go. 20. Not controlling what you can. While no one can predict the market, investors can control small contributions over time, which can have powerful outcomes. I would also say that, similar to what we talked about, we can't control what the investment returns are, but we can control other things. So thoughts on that, Jason?
Sure. And I think a great example of this is, you know, the Oracle of Omaha, Mr. Warren Buffett himself. Brilliant man, you know, known as one of the greatest, you know, investors of all time. One interesting thing about him is he started investing, I don't know what the age was, but like in his teens, and he's been doing this forever. So I don't know how old he is now, but you're talking, you know, an investment career that's spanning
Decades.
probably yeah, probably 50, close to 60 years of investing. And it just, I'm not saying he wouldn't be where he was if he didn't have that time horizon, but you know, it plays a big part in it. And yeah, you can control what you can control, take advantage of the compound, you know, interest, and get started early. It kind of falls, number 20 and 19 seem very similar to me, but
Yeah, they do. They
yeah,
do. But you know, for a lot of senses, you know, even if you are older and you don't have time, but you can, there are still things that are within your control, and there are things that are outside of your control. And it's just choosing which one to focus on, I think.
yeah, no, and I like that. And you can't, so I noticed a lot of people live in worlds of what ifs.
Mm-hmm.
Um, and rightfully so, but we need to, and this is just my opinion, you have to operate in an environment where you assume, based on historical context and educated guesses, things are going to continue.
Mm-hmm.
If you live in a world of what ifs, then you're ultimately, you know, susceptible to any what if, right? Because if you're going to say, well, what if this war and this collapses and this, I mean, if that's your justification is what if, then what if you're wrong? What if this happens? What, you know, so being in a world of what ifs is tricky, because, you know, once every long while the what if does happen.
Yeah.
But I think you have to operate, at least for retirement planning and an investment perspective, in a world of educated guesses based on historical context.
Right. And you know, the saying like, oh well, you know, people say like, well, this time's gonna be different. Well,
Sure,
like
sure.
Jason said, like, yeah, maybe that outlier once in a while is the case, but like historical comes back to the fundamentals, right? The basics. Um, and again, it's controlling what you can control,
Yeah.
focusing on what's most important. And in a lot of ways, with all 20 of these things, right, that we've talked about in part one and part two, it's really just understanding where you're going, understand the goals, the purposes of the money we're trying to, you know, use or work with. And if you work with somebody like Jason or I, or an advisor, knowing that they have the understanding of where you're going and are helping you along the way, that's a lot of value there. So with that, Jason, this was fun. I'm glad that we went through these 20 most common mistakes that investors make from the CFA Institute. But with that, final thoughts?
No, it was fun, something a little different, and we'll catch everybody on the next one.
All right, have a good day.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions opinions expressed by Jason Cutitta, Paul McWilliams, and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial or Inspire Advisors. For Jason Cutitta, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration. And for Paul McWilliams, investment advisory services are offered through Inspire Advisors LLC, a registered investment advisor with the SEC.